Welcome back to Money Ventures. The second trending topic in our series is EFTs. If you've been hearing a lot about index funds and ETFs lately, you're not alone. Simple, low cost investing is trending, and for good reason. More people are looking for passive, long term investing strategies that help them beat inflation, avoid the stress of day to day trading, and grow wealth automatically in the background. Today, we're breaking down exactly what index funds and ETFs are, why they're so popular, and how beginners can start using them to build steady financial freedom. Think of this as your easy guide to investing without the complexity, the confusion, or the high fees. So let's start with the basics. What exactly is an index fund? An index fund is a type of investment that tracks a particular market index, like the S&P 500, which includes 500 of the biggest companies in the US. Instead of trying to pick individual winning stocks, you're buying a little piece of every company in that index. This gives you instant diversification and dramatically lowers your risk compared to betting on a handful of individual companies. And because index funds are passive, meaning they follow the index automatically, the fees are extremely low, so more of your money stays invested and growing over time. Now, what about ETFs or exchange traded funds? Think of an ETF as a cousin to the index fund. They work almost the same way. Many ETFs also track major indexes, but the key difference is flexibility. ETFs can be bought and sold throughout the day, just like stocks. That makes them perfect for beginners who want low fees, diversification, and the ability to invest on their own schedule. Whether the market is open for 5 hours or 5 minutes, you can hop in, add to your investments, or adjust your strategy without needing a complicated plan. Here's why index funds and ETFs are trending right now. People want simple, they want stress free, and most importantly, they want results. Investors are finally realizing that long term wealth doesn't come from trying to time the market or jump in and out of hot stocks. It comes from consistency, patience, and low costs. With index funds and ETFs, you're investing in hundreds, sometimes thousands, of companies at once. That basket of investments spreads out your risk while allowing your money to grow with the overall market. Over time, the market has historically trended upward, and by riding that wave instead of fighting it, many investors see strong, steady returns. Let's talk benefits. Low fees are a giant win. Because these funds are passive, you're not paying a manager to constantly trade. That alone saves you thousands over the long term. Diversification is another huge benefit. In one purchase, you're owning parts of many companies, industries, and sectors. And with a long time horizon, these investments do exactly what they're designed to do: compound. Small, consistent contributions can grow into major wealth because your returns earn their own returns year after year. It's the definition of building wealth while you sleep. Now, here's a smart tip that more investors are exploring. If you're investing in index funds or ETFs, consider looking into ESG-focused funds, which screen companies based on environmental, social, and governance standards. They're great for people who want to grow wealth and support companies making a positive impact. But here's the key. Don't choose a fund only because it's labeled ESG. Make sure you evaluate the same traditional metrics: performance, expense ratio, historical returns, how well it tracks its index, and the types of companies it holds. Impact matters, but strong fundamentals do too. So how do you start? First, pick a reputable brokerage. Options like Vanguard, Fidelity, Charles Schwab, and several low-cost apps make it easy to open an investing account. Next, decide your goal. Are you investing for retirement, long-term wealth, a major future purchase? Your plan should match your time horizon. Then choose your funds. A common beginner strategy is to start with broad market options like an S&P 500 index fund, a total stock market ETF, or even a target date index fund that adjusts automatically as you age. From there, commit to consistent contributions. Even $25 or $50 a week adds up fast. The key is starting early and sticking with it. And here's your reminder. You don't need to pick the perfect fund from day one. You don't need to know everything about the stock market. You don't need to watch financial news all day. With index funds and ETFs, the goal is long term simplicity, not short term perfection. Your job is to contribute consistently, leave your investments alone, and let time do the heavy lifting. So, whether you're a complete beginner or someone looking to simplify your strategy, index funds and ETFs are some of the most powerful tools available. Low fees, broad diversification, automatic growth, and less stress. It's everything new investors need, wrapped into one clean strategy. If you're ready to beat inflation, grow your savings, and build wealth without spending hours researching stocks, this is a perfect place to start. Remember, slow, steady, and consistent wins. Your future self will thank you. Please like, comment, and share for more practical money insights. See you in the next video.